Yes, my traders. Happy Sunday. I hope we're all well and truly lit. Yes! We are back. We are back with another week in these beautiful markets. And boy, I'm sure you guys are aware. You may not even obviously trade sort of fundamentals and macros, but you can see how much markets are being shaped up by the macro environment, how sensitive they are to all these developments, geopolitical, politics in general, economic slowdowns, trade wars, you name it. There's a lot going on right now with gold obviously ripping it to all-time highs. We've seen queues and queues. You know, people are crazy. There's people queuing up to buy gold. Man, this is not the time you start jumping in like the sheep, because you know I've said before, the sheep get slaughtered. Whenever they're talking about it in the news, whenever they're talking about it in the press, that's when you know, stay the hell away. If you're not in already, stay the hell away, because the sheep come in and the sheep are getting queued up to go to the slaughterhouse. So we've obviously got gold ripping it to all-time highs. I still find gold super sexy. We're going to break it down in this video. The dollar, if you look at a lot of the dollar pairs right now, we are chop, ranging, as you can see, ranging because we're caught within a key couple of macro themes, more than a couple, which we're going to break down in this video. And the traders, outside of the dollar related, there are plenty of divergences to capitalize on. You've heard me speak about divergences before. As you're trading the charts technically, you are simply speculating on which currency is stronger than the other, or which currency is weaker than the other. Now, when it comes to macros and you actually understand though, that's where you have greater edge, because you actually understand the little intricacies, the differences in why this economy is more vulnerable than the other one, or why this one is actually stronger than the other one. Then you're able to capitalize. You find that divergence and then capitalize on it. That's a massive confluence and edge for your trading. And traders, obviously we had our first live stream session on YouTube, which was super exciting. A lot of value went out with myself, obviously my top student, Stephen. If you weren't there, you freaking missed out, man. So you better be at this one this Tuesday, okay? This Tuesday, same time, 12:30 London time onwards, obviously for London, New York crossover. Guys, be there, because obviously we're breaking the markets down on a macro level and obviously on a technical level, tying it all hand in hand. Come there, because there are going to be some giveaways for a big value service that myself and Stephen are going to be running. So make sure you come there. Do smash up the subscribe button and the like button. Turn on notifications. Anyway, let's jump into this video, baby. So traders, where should I begin? I think we'll start off with gold, because gold has been ripping it. You know, it's one of the biggest, most volatile assets at this moment in time. And obviously I've been seeing a lot of videos across sort of social media on Instagram, X, you know, you got all the gurus trying to call the top, saying this is the top. Obviously everyone just, again, you know, when you're calling the top, you're just as bad as the herd, you know. You're just following each other's butts. At the end of the day, look, yes, I get it. We are overbought. And this is a time where you should be cautious about loading up on gold on a physical buying level. Okay, at the end of the day, we're still speculating on the price, right? And this speculation right now that we're seeing, these huge moves, what are we at? Is this 9 straight weeks? A 1, a 2, a 3, a 4, a 5, a 6, a 1, 2, 3, 4, 5, 6, 7, 8, 9. This is 9 consecutive weeks to the upside of buying for gold. And look, technical gurus, I get it. Yes, we are somewhat overextended and overbought. But now, more than ever, have we ever been supported by so many fundamental factors, so many macro factors. As I've been screaming about it for a long time, the central bank buying, the physical loading up, sovereigns are buying of gold from their reserves. And then when you look at gold ETF flows, these are chunky. So we've got big central bank buying, so that's on large quantities. We've got massive institutional buying, a lot of portfolios structured around gold products. Huge, big inflows here. We've got the geopolitical tensions, which are extremely high. As we saw last week in a previous video, I went over, right, with US and China. Well, Trump and Xi Jinping, the two lunatics, crazy dudes, okay? These are the two biggest, right? Well, they're the two biggest economies in the world, run by a couple of the biggest Looney Tunes on the planet, okay? Xi Jinping may come across like, he's all normal, but this guy's a lunatic. They're both lunatics. As much as I like Trump and the volatility he brings, he's a lunatic. So we've got two lunatics going head to head in this trade war, which is going to be absolutely crippling. I'm going to talk about this in a lot more detail in a separate video, but it's crippling on a global economic level. We have also the tensions. Man, did you see? So this So the Gaza, the ceasefire in Gaza, excuse my spelling, here we go, has been a breach. They're both blaming each other, both Hamas and the IDF. So we've still got that fighting going on there. Anything else I've missed? And the government shutdown. This becomes the third longest in history with no end in sight. Government is still in shutdown in the United States. That's huge. There's a number of departments that are just not operating. There's a number of people that are being laid off. This is big, but markets have sort of swept it under the rug for the time being. But this is uncertainty. So with all of this that I've just mentioned, and I'm sure I'm missing some other points, right? With all of this, it's creating uncertainty and it's supporting that flow into gold. And then, of course, obviously the rate cuts that are coming from the FOMC. Obviously, markets have been ramping up pricing for them. Obviously, they're aggressively priced, which is something we're going to talk about in a moment for the dollar anyway. But if we look technically here for the gold, obviously on a monthly, it's still big bull territory right now, okay? On a weekly, still no signs of a slowdown at present, right? We've left this big bullish candlestick. There's no reason as to why we can't potentially technically, obviously we've got all the macro factors supporting it right now, continue to push the upside and take out last week's highs. Obviously, remember I called the buys last week. I would like to see that again. Structure is still intact until, look, I trade what I see. I'm not one of those gurus that's like, oh, let me try and call the top. No, I trade what I fucking see. Excuse my French. I trade what I see. I have my fundamentals to marry and support that view. If things change, they change, then I move and I'm nimble like that. I'm not trying to call tops. Structure is obviously still intact on the daily. Arguably, right, when we look at this area here, and I'm going to talk about the longs that I've had last week, but arguably, this structure is in still intact and we've printed still a higher low here, subject to a higher high. And we go and take out, we put this zone here. We go and take out this zone to the upside. It's held. That's on the 4 hour, you can see that. Okay, so we've got room to potentially see a continuation to the upside, especially now this Middle Eastern stuff, as I say, over the weekend. You could see the ceasefire is not holding out, which is geopolitical tensions all over again, renewed. So gold still remains potentially attractive. I just want to quickly point out, just from an educational standpoint, right? Remember those us talking about gold upside further this week? Okay, what we saw was a nice, beautiful double bottom here. And I put this out in the macro marshals, like, watch out. We do have a potential double bottom forming here. Look, 1, 2. And what was beautiful is we've got the Asian range here. We tested the Asian range low, not once, but twice. And look at the time, New York, London, New York, double bottom, waited for that reversal candlestick there, around the daily open as well, as you can see it, the Asian range low, bit of manipulation coming into play, look, boom, boom. Closure above, took those logs. Okay, and I looked for 2R. I just basically hit the psychological 4.2 area, okay? Take it out these highs for a higher high as part of structure. And look at the freaking structure, guys. You trade what you see. And this, as I say, profit taking at the end of the day. We're in the abyss. We're literally in the abyss. Where do we go? We've got no technical levels up here. It's like, So we're just trading structure and obviously trading sentiment. And now we've had that pullback, but this key zone has held around 4,200. So long as this holds, guys, I think we're going to get a continuation this week. Probably a bit of an inverse head and shoulders here, like where it's bottoming out, left shoulder, head, right shoulder, there or thereabouts. Not the cleanest, but a bit of an inverse head and shoulders. I would like to see some more buying, given that things still remain uncertain for gold. And then the dollar traders, look, it's been in a range for many months now, okay? Because we are lacking to find a real serious catalyst to break us out and get that full on commitment in terms of direction. We remain vulnerable, okay? And I'm just going to quickly talk about the factors and then we'll look at this technically. We remain extremely vulnerable when we look at the macroeconomics, okay? There are more bearish factors for the dollar than there are bullish, okay? More bearish than there are bullish. And the reason being, I'll quickly name them. We've had obviously the trade wars, right? Since Trump came into play, obviously we had dollar selling on the fact. We were buying on anticipation with the Trump trade, and then we sold on the fact. Then we had all the uncertainty with the tariffs. Trump was going at it, Liberation Day, which obviously worked against him. We had obviously all the uncertainty there, big capital flows out from the United States. Okay. Then obviously we've got the full-on trade war with US and China. Okay. And then obviously we've got markets ramping up rate cut bets for the FOMC, given the worsening in the labor market. So structurally, and on a macro level, dollar's obviously bearish. As you can see here, we have still, obviously, albeit we're in this range here, but we've been printing lower highs, lower lows. Obviously, you can clearly see that for yourself. And now we're just caught within this range at present. It's a little bit mixed for me because obviously on the monthly, we have the potential to stage a a rebound, and the monthly potential reversal doji followed up with some possible buying. So, well, some buying so far in the month of October. Obviously, it's still early days, and really we need to push for a closure above. But the weekly still screams vulnerabilities. The daily, when we look at this here, at the moment, we have obviously been printing higher highs, higher low, higher high, and this is potentially being a new higher low for a possible higher high in towards 100, and see how we deal with that area, because obviously there's a lot of supply there, as we saw a huge rejection there in July. So we have potential room to maybe buying into that, but I would take it with a pinch of salt. Any dollar longs, be extremely cautious because of all those macro bearish fundamentals that I noted. The one big positives for the dollar is that, or could be positives, if when you look at the CMC, right? Go onto the Fed Watch tool. So when you look at the month of October, 100% pricing that they're going to be cutting by 25 base points. Same as December, same as January, same as March, same as April, same as you. Markets are like so aggressive with this rate cut pricing, which means there is the potential for disappointment. So if the FOMC at some point decides not to cut rates, or they're not so dovish as what markets are pricing in here, because this is freaking aggressive, and the only reason they're freaking aggressive is because of Trump pressure on Powell and the FOMC, which is why they changed their tune. Because look at inflation, it's still sticky. The labor market's not that bad. You know, the economy's not that bad when you look at data. And I'll say, should we say the lack of data right now, because obviously the government shutdown. But my point is, the risks are to the upside there for disappointment, which could aggressively force markets to start repricing the rate cut price, the rate cut bets, should we, as I say, see some disappointment or a change in tone from the FOMC. But right now, obviously, it's all doves go. Now, talking about data quickly, we're supposed to have the key CPI data this week from the United States, but to be honest, it's lost its credibility. All right, there's a nice article here in Bloomberg at the moment just saying how, you know, obviously this inflation reading is obviously already at risk. We've seen that BLS, so the Bureau of Labor Statistics, they've recalled some staff saying, come back. I know we're in shutdown. No, we're not able to pay some of you, but please come back. Let's try and get this data out. But the thing is, with this data, as they've said here, the agency hasn't been able to gather the data needed for October reports on prices. So they're not able to gather everything that they need because everyone's in freaking shutdown. So they can't access certain departments, certain criteria, certain factors. So it's just BS, basically. So don't expect any fireworks with this data, to be honest with you, this week. I mean, if it does, it'll just be a whipsaw and markets are not going to want to commit. All this data, generally speaking, the government-based data, take it with a pinch of salt because it is shut down. Okay. But as I say, dollar, keep an eye on what I just said technically there. But still, on the higher time frame, generally speaking, we do remain vulnerable to resumption of the downside. And in traders, there are a number of opportunities for divergences. As I touched upon at the beginning of this video, right? We are simply looking for more factors to support a stronger currency versus the other one, or more factors to support a weaker currency versus the other one. I'm finding those divergences, whether it's on an economic level, right, with key economic data, but then also more so on a central bank decision, whether we've got one central bank cutting rates faster than the other one more dovish than the other one, which obviously speeds up weakness in that respective currency. Because remember, when we are cutting rates faster, we are discouraging investment coming in. Instead, we are, prompting people to want to take their money out and get a yield elsewhere. And one of those key currencies for me, where I found a divergence versus peers, is NZD. Now, I was screaming about this for a long time. Stephen and I, obviously Stephen, via the Macro Mastery, we both put out our outlooks for currencies. We've done this for the last couple of months, and NZD has been on our radar. It's ranked number one for a long time. And the thing is with NZD is there's so many bearish factors right now. If we just start off indirectly for a moment, we've got US and China. And obviously China is New Zealand and Australia's biggest two-way trading partner. So anything negative that goes around China is negative for New Zealand. Because if China starts slowing down, China are going to be buying less from NZD or buying less from Australia. I haven't put Australia there for a reason, which I'll talk about in a moment. One of the key reasons is the RBNZ is more dovish than the RBA. Now, NZD is also vulnerable as a commodity-linked currency. When we have economic or global economic slowdown, commodities get hit hard. Commodities are extremely sensitive to global risk appetite and global sentiment, right? Sorry, I meant global sentiment. And the other thing is the fact that NZD is a commodity-linked currency, and commodities in general are extremely sensitive to global economic outlook, to global economic growth. If we are seeing a slowdown in the global economy, naturally people start cutting back on one of the main things is commodities, commodity buying. So NZD gets hit as a double whammy on a global economic slowdown in general, right? Being a riskier currency, being a commodity-linked currency. The RBNZ is dovish. China indirectly. There are just so many avenues, which is why NZD is extremely vulnerable. And I had a couple of trades last week around this divergence. Obviously, Euro's a bit stronger right now in comparison to the RBNZ. It's more stable over there. The ECB in comparison to the RBNZ, they're on hold, but then the RBNZ have been cutting. And again, this came down to simple structure. Obviously, I don't just trade trend lines, okay? I trade a number of things, right? But I've just put this trend line here just to show simplicity when it comes to sort of structure. And I'd gotten in on this new higher low, looking for a higher high, okay? Simple, right? It was watching that reversal candlestick, watching that touch of that, that structure, that confirmation of that low, that bullish engulfing bullish candlestick, and then seeing that continuation and looking for obviously that higher high, right? As part of that structure. Now I had some runners. I had the higher high up here, right? And then also had a runner into that psychological 204.50 area, there or thereabouts. So it was just shy of that. So it's just a push on. I was expecting a continuation of structure. I wasn't expecting that to break, and we had those longs. I had a similar setup with GPNZD as well. Again, coming in at a new higher low, looking for a swing high. Obviously, to take out this high, went for the psychological around 234.50, there or thereabouts. And it's just, look, again, this is just so simplicity of structure. You know, when you're just looking for reference points, obviously higher high, higher low, higher high, and you could just you could mark up a trend line there just to show where we're most likely, obviously where the mass market, the retail guys, and just general market psychology, mass psychology. I always think about that when I'm trading mass psychology. What do the market think about? Where are their reference points? Obviously, we've got the psychological 234.50 area, but then also we've got this trend line where people are going to be having marked up with these high highs and these higher lows, so on and so forth. So anyway, that also being a target. I also had GP CAD. There's a divergence there, as you've seen. Obviously, CAD's ranked my weakest. GP stronger than CAD, in my opinion. And now I'm a bit gutted about this because I had this long here. Again, obviously, when you look on the higher time frame, we were structured to the upside with reversal candlestick here, bullish engulfing, and it's staging a rebound. On the 4 hour, you can see that structure starts to take shape. I was observing this. I was like, okay, here we go. High. This is the low here. Broke this structure here. High, higher low. I was looking for this higher high. Now, I did actually take the trade, okay, on the Asian liquidity sweep, the range low, reversal candlestick, closure above, and then swang that to the upside into that psychological 87.50 area. Now, I took this trade, and ultimately, my target was up here at 188, okay? It's in this zone. But I took those longs, and then I moved my stops to break even. I did manage to clip some profits at that sort of 87, that psychological 87.50 area, but ultimately, I was looking for a run all the way into 88. And then the remainder of the position was taken out because we had poor UK GDP data, right? No, excuse me. That wasn't GDP data. That was the labor market data if you look last week. So yeah, we had poor UK labor market data. The amount of unemployment benefits jumped, 25.8K unemployment claims, and the unemployment rate jumped up to 4.8%. So that's why GP had sold off there. But then we bounced and reversed because ultimately the fundamentals are more bearish in Canada and they are more subject, again, just being a commodity linked currency, being vulnerable to this US and Chinese trade war, so on and so forth. So guys, a lot going on in the markets, plenty to potentially capitalize on if you position correctly. As I say, I'm not saying macroeconomics are the be all and end all, but I'm saying if you do combine it with your technicals, I can assure you, if you are a technical guy and you're very freaking good at your strategy, right? You good? Come here. Let me show you how to really gain greater edge by implementing this macroeconomics, as I do with my various technical strategies. Guys, make sure you tune in on Tuesday for Stephen and I, our live stream on my YouTube channel. Please, if you want these videos, if you want this content, you're gonna have to smash up that subscribe button. I don't know how we're still on 12.5K freaking subscribers. Smash up the subscribe button, smash up the like button, drop a comment again. If you're gonna be coming on Tuesday, I got some giveaways to come for our amazing, beautiful service that we're going to be launching. Stay lit, stay blessed, and let's get it.